Welcome back. You're still watching Power Lunch. We continue our conversation regarding Brexit and the activities unfolding as Britons take to the polls today to decide whether to stay or to leave the European Union. Still joined by Gary Boyson at the desk today, Rand Swiss Director and Portfolio Manager. With all this excitement, clearly the conversation does continue. But we also joined now telephonically by Jean-Pierre Kloppers, who's the Chief Executive at Brand's Eye, and that's to tell us more about the social media trends that have been unfolding. JP, thank you so much for joining us today. I understand that the polls have, or rather the indications on social media regarding the polls have changed dramatically. There was priced in that maybe 80% are looking at a Remain vote, but what does social media tell us at the change in this trend at the moment?
Thanks. Yeah, great to chat to you. It has been exceptionally interesting looking at the sort of polls, if you like, on Twitter this week. We looked at about 500,000 conversations over the past couple of days and took a representative sample of that, and shockingly 60% of people on Twitter from Britain look like they are going with the Leave campaign, which is totally contrary to what we're seeing in other polls, and it is interesting to see what social media is saying.
JB, yeah, when you did your analysis, I mean, what other trends have you picked up? I mean, you know, from reading the newspapers, I mean, you feel almost that the Leave camp is very much an immigration issue. I mean, what trends are you seeing in social media space?
I think the trend we're seeing, and we've seen it in other elections around the world, is that the voice on social media often has an indication of which way the surprise is going to go. And what no one's yet been able to quantify or prove is just how big the surprise is. You know, if we look at South Africa in the last elections, no one knew between Gang and the EFF, you know, which way was it going to go, who was going to gain how many votes. But from social media, it was kind of clear that the EFF was going to win hands down. So whether what we're seeing in the Twitter conversation, and bear in mind it's not a poll, this is just people expressing their opinions, and it is a large sort of quantum of conversation. What I'm interested to see is how does that compare with, you know, the shy Tories, and when they come out, are they going to be swayed by the sort of conversation that's happening on social media that Britain's losing its identity and so needs to return to the good old days, if you like, which is a similar rhetoric to what we hear in the USA at the moment, as a matter of fact, and how influential that voice is. We're seeing it quite loudly this week on social media, which is indicated by those stats. Whether it's loud enough to actually win the referendum, that is everybody's guess at this stage.
JP, thank you so much for your time. Unfortunately, we have to leave it there for today, but we'll continue touching base with you to take a look further at some of the trends on social media regarding Brexit. That was JP Kloppers, CEO at Brand's Eye. Well, earlier on Open Exchange this morning, my colleague Dumisho Greater hosted a panel who shared their views on the impact of Brexit on the continent overall. Let's take a look.
I think the EU as a whole is a significant trading partner for South Africa. Within the EU, the UK, for example, last year 20% of South Africa's exports to the EU went to the UK. So if the UK were to break away, the so-called Brexit from the EU, certainly there would be some uncertainty in the trading relationship between South Africa and the UK going forward. So I do think it would be significant for South Africa, but I think the biggest thing we have to remember is that there's very little that South Africa really can do about the situation at the moment.
So with this week being quite a tense political uncertainty around Pretoria, what do you think is going to be the driving force? Is it going to be British exit, or is it going to be a continuation around this political uncertainty leading up to August elections?
I think absolutely both factors come into play. You know, when you look at the domestic economy, what influences that? It's both domestic affairs, but it's also what happens in the global sphere. You know, for example, even in the US with the elections, we see that ultimately that would have an effect on South Africa. So South Africa is very much tied into the global scenario. So anything that's significant that happens in the global sphere would ultimately have an impact on South Africa as well.
We having a look right there on the board. We had a look at your research that you were doing and the South African imports and exports. But you also said, we've been looking at things from a South African perspective. The EU will also be impacted too.
Absolutely. Again, the UK is currently the 5th largest global economy, right? So obviously within the bigger European Union, it's a significant player. And I think, again, the key thing here is the uncertainty that would come about if the UK were to leave. We know that there will be a 2-year negotiation period, but ultimately breaking away would cause a lot of uncertainty, both for the UK and the EU as a whole, and as we know, that's certainly not a good thing.
Before Travis comes in, Cyril, are you able just to first maybe tell us about some of the scenarios that may play out? And I think we think about a possible exiting. I've been hearing that this is not a light switch that you can switch on and off. It's going to be a process. So are you able to give us some color around maybe how long this process may be if it were to happen?
If it were to happen, I think it's difficult. I think we have to remember that the UK has been trading with South Africa under the preferential trade agreement it has with the EU. So obviously, if the UK were to leave, I think they have one of two options. One, they join the European Free Trade Association, which is kind of a sub-association of Norway, Switzerland, Iceland, and Liechtenstein, who has a free trade agreement with SACU, the Southern African Customs Union, and they'll be able to trade within that regime. The alternative is to negotiate a bilateral trade agreement with South Africa. And 2 weeks ago we saw the signing of the economic partnership agreement between Southern African countries in the EU, and we know that agreement took more than a decade to negotiate. So it's very difficult to say, and I think the last thing to remember is that if the UK were to leave the EU, they would prioritize their negotiations with their biggest partners. And in that sense, I think South Africa would have to fall kind of in the back of the queue, because for the UK, South Africa is not necessarily their biggest trading partner.
I want to go quickly to social media. I do know that Travis was talking to us earlier about some of the polls that are starting to trickle in. Looking at from a social media perspective, we've got Jean-Pierre Kloppers. He's the Chief Executive at Brand's Eye. Jean-Pierre, thanks for joining us this morning. What have the polls been telling us from a social media perspective? Can you maybe give us some insight? People, Brexit or Remain?
Yeah, thanks. Good to speak to you. It's actually been completely surprising. We looked at just over 500,000 conversations from Britain over the past 3 days, and taking a statistically significant sample of that, the result was 60.1% of people are saying leave, which was very surprising to us and a little bit shocking, actually.
Jean-Pierre, I was looking last night, and I don't know if you looked at Optimum Research. They did a research on over 3,000 UK adults where they surveyed 45% to leave. So you're saying that's increased quite substantially, and do you think that social media will crash? Because a lot of the sites were crashing last night just to the impact with all the people coming in?
I don't think they've crashed. No, not the platforms. We've seen really big events go down over the past couple of years, and this is 500,000 is nothing compared to that. So I don't think we'll have an issue there. What I found interesting from this is that it is counterintuitive. Most of the polls are putting it at that kind of 45 to 50% saying leave. This is the first time we saw that percentage go significantly over that. What it means, it can only be one of two things. Either it's just a very vocal leave campaign on social media, which is kind of muddying the results, or we've underestimated the influence of the leave campaign.
Well, we continue our conversation now on Brexit, and Gary Boyson from Ransus is still with me. But joining us in conversation now is Gavin Williams from Herbert Smith Freehills. Good to have you with us today, Gavin. Now, you've been quite vocal saying that the potential impact of a Brexit on South Africa would impact on South African firms who have exposure to European capital markets quite negatively, because it means that they could have to go through a whole new regulatory process with the EU and the UK separately.
Yeah, that's right, and thank you for having me on. I think right now many South African firms, along with lots of issuers from outside of the UK, use the London market to raise capital for their investments and expansion. And right now they use the UK regime, and they passport their securities offerings into Europe on the basis that is allowed under the terms of the UK's membership of the EU. Now, one of the great risks of the UK leaving the EU would be that what's called a passport would be lost. And if it were to be lost, then the way in which South African companies access the European capital market could well have to change.
Yeah, I've actually seen. I think it's if there was to be an exit, that 75% of workers within the UK would no longer qualify under non-EU regulation. I mean, what kind of timeline would we look at if there was an exit in which the actual effects of Brexit would roll out?
Well, it's a very good question. I think the structural reforms could take a very long time indeed. The treaty that establishes the withdrawal process provides for a 2-year negotiation period. But that's just to negotiate the terms of the exit rather than the new arrangement that the UK might have in the future with the EU. Now, I don't think it'll be in anybody's interests for there to be a disorderly process or for it to be unduly disruptive, but at the same time, it's clear that we wouldn't have the same degree of access to the single market in the UK if we were to leave the EU, as we currently enjoy as a member, and that's where the rub is, if you like. There would have to be a great deal of complex negotiation as to what we'd have to give up, and that would create a prolonged period of uncertainty. And that's for the structural changes. I think the other thing to be conscious of is that there could well be a market shock on Friday if today's vote goes against continued membership. The banks and the IMF are all anticipating that the currency, the pound sterling, could lose somewhere between 10 and 20%, and likewise the equities markets could take a hammering too. And that's more immediate in terms of consequences that we might see in the next 24 hours or so.
Gavin, with this migration of capital from London, I guess it adds another spanner into the works with regard to where capital will then be chosen to be raised. But does it present new opportunities for certain entities outside of that base?
Sure. I mean, look, the other major centres in Europe have for a long time eyed with some degree of envy London's position as Europe's principal capital market, and I'm sure that there'll be people in Frankfurt and in Paris who, while maybe not cheering for Brexit, would not necessarily be entirely disappointed if the UK were to find itself in a position where some of the activity that is currently carried on in London found itself migrating across the Channel, or for that matter, across the Irish Sea to Dublin. So, yeah, I mean, there certainly would be opportunities. Some of the major investment banks have indicated already that they expect to relocate a portion of their activities out of London, and that clearly would create opportunities in other centres in Europe.
Gavin, thank you so much for your time. We'll have to leave it there today. That was Gavin Williams from Herbert Smith Freehills speaking to us from Athens. Well, that's how we wrap up our view of the South African markets for today here on Power Lunch. And a big thank you once more to my guest, Gary Boyson, a Director and Portfolio Manager at Ransus. Again, you mentioned that you're quite keen on Brexit remaining in the European Union, but we like the news factor.
Yeah, of course. You guys are journalists. You want to leave.
We want to leave, but hopefully it won't affect our portfolios too negatively, Gary. Thanks again for your time today. And that's how we wrap things up once more. Do stay tuned, because after the break, we turn our focus to the West African bourses, where not only does the conversation continue regarding Brexit, but also the FX changes that recently took place in Nigeria too. And we find out how the Naira has managed its trading against the US dollar. Power Lunch West Africa will be back right after this.
Following the UK's vote to leave the European Union, the Brexit, the rand plunged more than the day President Jacob Zuma fired the former finance minister before recovering, and it's recovered again. What more should emerging markets expect? Joining me in Johannesburg is Timothy Namo, Director of Global Financial Innovations, Nick Krell, Portfolio Manager at Ashburton Investments, JP Kloppers, CEO of Brands Eye, and also Daniel Silk, Political Economy Analyst at Futurist, joining us via Skype. But before we get into the discussion, here are some of the comments from the Bank of England's Governor, the Canadian Mark Carney. Here he is.
The bank judged that the risks around the referendum were the most significant near-term domestic risks to financial stability. To mitigate them, the bank has put in place extensive contingency plans. And these plans begin with ensuring that the core of our financial system is well capitalized, is liquid, and is strong. This resilience is backed up by the Bank of England's liquidity facilities in sterling and foreign currencies, and all of these resources will support orderly market functioning in the face of any short-term volatility.
That was the Bank of England's Mark Carney, a Canadian fellow, and people are talking about now interest rate cuts in the United Kingdom. I want to read you something now before we get to our guests, and this was written in 1624 by a geezer called John Donne. He said, "No man is an island entire of itself. Every man is a piece of the continent." This is 1624. "A part of the main. If a clod be washed away by the sea, Europe is the less, as well as if a promontory were, as well as any manner of thy friends or thine own were." In other words, he was a federalist almost. Let's talk about that now. Was he forward thinking? Was he backward thinking? Have we gone backwards in the last 12 hours or so? Timothy Number, let's start with you, Director of Global Financial Innovations. What do you make of this extraordinary story, Timothy?
I suppose basically this was a bit of a surprise result. The polls, etc., and also the bookies had been predicting a Remain vote, but quite early in the early hours of the morning, it started to the early polls started coming out with a different result. I'd be inclined to agree with the view, but I suppose lately you're starting to see sort of left, I suppose, I'm not sure if it's left-wing or right-wing views with Donald Trump in the States, and then also in the UK, speaking to a lot of my friends there, the big concerns were immigration and things like benefit fraud. So I think a lot of the feeling was that they would be better out of the EU in order to get more control over their legislative environment and so on.
Quite right. Donald Trump, you mentioned that name, and he's arrived in the United Kingdom in the last 24 hours in, I think, a Gulfstream jet, registration G-TRMP, and he's been snubbed by various politicians. That's going to be the next big story. But let's talk about the one that is top of mind at the moment with Daniel Silk, Director of the Political Futures Consultancy. Daniel, I don't know about this one. Have we gone backwards? Have we gone forwards? Is it going to cause contagion? What are the implications for the emerging markets? What is your view? Let's go.
Yeah, I can hear you perfectly.
Let's go to Nick Krell. Oh, good. Okay. Did you hear the question? I mean, it's a simple question. What is the view here? But what I'm sort of trying to understand now is how the markets will evolve over the next few days, months and weeks? Because the snapshot that we've seen in the last 6 or 7 hours or so really is something that is sort of almost predicting what our next 2-3 years are going to be like. No, we're battling with that. So let's go now to JP Kloppers, CEO of Brandseye. JP, can you hear me?
I can hear you.
Very good. What I saw at 11:32 last night was something from the internet that said that Nigel Farage, who's the head of UKIP and very much an exit man, said we concede defeat. And then I got a call at 4:07 this morning saying, have you seen the markets, Lindsay? The S&P 500 futures are limit down. The market got it completely wrong, but apparently social media got it right.
That's right. Yeah, we started measuring at the beginning of this week what is Twitter in the UK saying about Brexit. And interestingly, when we looked at that stage, it was about 200,000 people that we sampled across Twitter on social media. And for the first 2 days, Monday and Tuesday, it was 60% of people on Twitter were saying leave. And we found that a shocking result. So we put it out to media almost tentatively to say, look, we know the other polls are going the other way, but it looks like from the sort of on-the-ground consumer sentiment that we measure through our technology, it looks like people are leaning quite heavily more towards the leave category.
Yeah, and in fact, there was something very interesting that happened to me around about 2 weeks ago. I spoke to a bookmaker, probably the world's finest bookmaker. His name is Paddy Power from paddypower.com. And he said to me the following. He said, Lindsay, it's 2-7 staying in. It's 13-5 out. In other words, you put £7 on to win £2. And that's if you think that Britain will remain in the European Union. And if you put £5 on, you get £13 back if you think that we will exit. And he said to me the following, and this really shocked me. He said 80% of the money is going for getting out. And a bookmaker's trade is all to do with money flows. So he was ignoring all his finer principles that he's learnt over the years. And I said to myself, this tells me that Europe is going to be minus Britain in the future. And it's an extraordinary thing. So it's not the pollsters. It's the social media people that are on the pulse these days.
Yeah, I think the big question was, what are the shy Tories going to do? That kind of silent majority of people, which we've always had the question mark, are they on social media? And it's quite a difficult question to answer, actually. But with the benefit of social media is because it's so large, you can just take everyone, and provided you have the tools to kind of process that big data and measure it, you can look at how that sentiment shifts even minute by minute and day by day. And on the day of the referendum, so yesterday, we saw the sentiment inversed. But on aggregate for this week, I know the stats we put out are 57% said leave. That was leading up to the morning of the referendum. And then including the referendum, it still sat at 53.5% leave, which was staggering. Yeah.
Daniel, we had some trouble speaking to you earlier on. I think you got my question, though. Daniel Silk is on Skype. Just your general thoughts about the most extraordinary 12 hours in financial history this century.
Yes, thank you. Yes, it has been extraordinary. And I think it's certainly, while social media might have predicted it, I think the pundits either didn't get it right or didn't want to get it right on this particular one. Look, I think this heralds in, as we've all said before, an era of substantial uncertainty. The EU itself was always an experiment. We're now in an experiment of extraction from the EU. And on both these instances, both sides, the 20 years of the EU plus this immediate period now is going to be fraught with a high degree of volatility. What interests me from a market point of view, and I think it alludes to your question, is that the team that will effectively be negotiating the withdrawal and renegotiating perhaps some of the preferential trading agreements that they hope to do, that team now has an extraordinary responsibility. The makeup of that team, what kind of people are they? Are they Tories? Are they a multi-party team? Are they a team that is forcibly Brexit supporting, or are some of them still remain supporting? And how does that influence these trade negotiations that are going to go on over the course of the next while? That in itself could create brinkmanship in terms of reaching agreements. And I think that, of course, is why we have this degree of volatility now. These are the unknowns for the next short period.
Nick Krell, Portfolio Manager at Ashburton Investments. We were going to talk about Naspers. Naspers is obviously very important, but I think this is more important. Naspers has been usurped by Brexit. What do you think? I mean, if it was 60-40, if it was 65-35, it was a landslide, 72% versus the 38%, I would understand. But the country is split down the middle. This, to me, is not conclusive, and I do think it's a dangerous situation, and volatility and uncertainty is going to rule the roost.
Correct. I mean, there's nothing nothing at all that will push an opinion in a different sort of direction. It's all about volatility at the moment. I think over the last couple of years, you've seen a couple of these potential risks come to the fore. If we go back a year again, it would have been sort of Brexit, and you could paint it that picture, a chance that if it happens, it could then really alter the world through a number of other events happening later down the line. And it didn't happen, and the world just moves on, and it was pretty simple and easy. I think this time, our expectation was that something similar would occur. It obviously, it gets emotional and tense the closer you get. However, as you get to that close, I mean, we're definitely more in line with, I think, the markets, and we can see what's happened, running up to today, but also the bookies. But now, the world has changed, and now trying to understand and unpack what is going to be the consequences of this is, to be honest, it's a bit of a mug's game in the sense that it is incredibly early on. I mean, we've got EU leaders meeting, I'm sure, very quickly at the moment, but more formal type of meetings within the next week, and getting a sense of not only what their opinions are, but also their voters' opinions are in terms of what could potentially happen over the next couple of years is going to be key to how the markets kind of see this. Either way, though, I can't really paint any sort of positive picture for markets and for the status quo for the next couple of years. It's just more volatility.
I've got to ask the one question to all four of you now. Timothy, JP, Daniel and Nick. My daughter, I didn't even know she could read, even at the age of 19, but she sent me a message this morning. She said, Dad, you're probably a little bit fed up with being asked, but what do you think about the Brexit vote? And I said, short-term, tricky, long-term, probably good. Yes or no, Timothy? You first.
It seems that from a, I suppose, currency and financial markets perspective, there's an expectation that UK GDP will shrink, and then there's also a bit of a debate in terms of what that means. For example, in terms of the US raising interest rates, Janet Yellen had mentioned that they were holding off on looking too closely at a hike because they wanted to see how
you're hedging your bets there, Timothy. I'm going to move on to JP quickly because we're running out of time. JP, short-term tricky, long-term potentially good, yes or no?
I agree. I'd say yes.
Daniel Silk, next.
This turmoil can have a domino effect in Europe and could create the further balkanization of the EU going forward, and that's what concerns me.
And Nick?
Long-term, good for emerging markets. I can't see any other place where yield, where any sort of growth is really going to be coming from here at the moment. Developed markets, certainly between a rock and a hard place, and now it's a rock on top as well. It really doesn't look pretty. Good point.
I think that this is going to mean that I'm going to have to queue a little bit longer at European airports if I ever have to go through a European airport, which is bad. But on the other hand, I do think secretly, deep down, that this is probably very good, and the dismantling of the bureaucracy in Europe is probably a good thing. That's it for Power Lunch South Africa. Thanks very much to Timothy, JP, Daniel and Nick. We are going to go to West Africa now for Power Lunch West Africa. There's going to be so much more Brexit stuff on CNBC Africa throughout the day and the evening, so please stay with us, and I'll see you at 7 p.m. tonight for Business FM. See you then.